Welcome to another finance series. In the previous episode, I spoke about cash flow management, and today I'm going to be taking it a step further to look at effective cash flow management with a deep dive into the various components of cash flow. Follow me as I go into this round of presentation. Cash flow management is a critical aspect of running a successful business. It involves monitoring, analyzing, and optimizing the inflows and the outflows of cash to ensure that a company has sufficient liquidity to meet its obligations. In the last episode, we established that there's a difference between profits and cash flows. And we also mentioned that it is the cash flows that is used to settle obligations, not profit. So a company can be profitable but low in cash. So let's take it a step further and look at what effective cash flow management actually connotes. When we talk about the strategies for effective cash flow management, we're looking at prompt invoicing and following up as at when due. So you ensure that for your services, your invoices are sent out and you follow up significantly to get your cash flows. The next is that you need to optimize inventory management. What does this mean? You need to have a regular inventory management system or an effective inventory management system such that one, you do your stock count regularly. Two, you are able to identify when you are low on stock, where you need to reorder, when you need to, balance your inventory system as the case may be. Excess inventory helps you to tie up valuable cash. And then when you are low on inventory, you miss out on sales opportunities. So having an inventory management system that is efficient and that helps you to balance your stock levels matters a lot in your business. In one of the episodes, we're going to be talking about implementing an effective inventory management system. Like I said, for some businesses, especially in the agri sector, they typically buy more during the harvest season. So when we are not in the harvest season, how do you manage your inventory? What type of valuation approach do you adopt in your organization? So all these things matters a lot because to a large extent, inventory for some organization is huge on the balance sheet. Moving on, you need to also manage your payables. So you need to extend or negotiate longer payment terms with your suppliers. That way you'll be able to improve your cash flows without damaging relationships. Another point to note is having flexible financing options. So what we are trying to say here is that you need to utilize financing options as much as possible. If you have lines of credit, if there's invoice financing, particularly with your bank, make sure that you try to explore all that to help you manage your working capital. This would also ensure that you get quick cash when needed. We understand that there's a lot happening in the economy right now. Interest rate has also gone up, inflation rate has gone up, but there are still facilities that you can get from most of these financial institutions that would help you support working capital within your business. And then finally, you need to regularly forecast your cash flows. This would help you to identify and anticipate your future needs, and then you plan accordingly. So let's take it this way. We understand that with the way the economy is very difficult to plan. You can plan with exchange rates. In fact, for a lot of businesses, they might have started the year with maybe 1,500. And currently, you know what exchange rate is tending towards. But then again, when you plan, especially at the beginning of the year, there's certain things you need to do, like tracking your performance and then revisiting your budget to ensure that you are still in line. So for example, if you are started the year at 1,500 to 1,500 naira to $1, and at this stage we are already at over 1,600, maybe 1,689 at that last week. Every quarter, your FP&A team, the financial planning team, is expected to be updating. There's what we call latest estimates. So you have your budget from January to December. As of today, we are ending September. We expect that from January to August, you should have your actual position. When you now compare the actual position January to August to your forecast or what you have budgeted from September to December, let's assume for a business, you made a turnover of 100 billion between January to August. And then from September to December, you had projected that you would make maybe a 120 billion because most of your sales occurs towards the end of the year. Now, what you are doing when you add the two together is to have 220 billion, if I got that correctly, which helps you know where you are going to stand at the end of the year. So when you keep updating your budget or with your latest estimate, it helps you to track your performance and know, do I need to improve more? Do I need to push out more product? Do I need to push out more sales force, sales personnel? Do I need to change my strategy? What do I need to do to help me to be able to hit my budget at the end of the year? So that's what we are saying, regularly updating your cash flow forecast, regularly looking at your budget to see where you are and what you need to do to help you to achieve what you have budgeted for, or even if not 100%, but at least 70 to 80% of your budget. I hope this information has been very helpful, and I hope you've been able to get one or two things with respect to effective cash flow management. Thank you so much for your time. My next presentation, I'm going to be giving instances of some of the issues that businesses face and strategies that you can adopt to help you to resolve those issues. See you in the next episode. Have a good one.